All right, continuing our conversation on the markets now. As investors consider whether to remain bullish on risky assets, the Fed makes it clear that elevated interest rates are here to stay. Markets are coming around to that idea, but here's how to position yourself defensively. Joining us now, James Demmert there, Main Street Research Chief Investment Officer. Thank you so much for joining us, James. So trying to make some sense of this, obviously we heard a bit differently from Jamie Dimon about the risks that he's seeing, but still this rally that we're seeing into this year. Is now the time to be bullish on these risk assets?
Yeah, a good question. And this rally to us looks a lot like the previous bear market rallies we've had for the last 15 months. Very narrow leadership. You got a VIX all of a sudden gotten really complacent again. And I think the problem here, and where investors really want to be careful, is that you've got Fed policy that's probably going to continue to be tightening right into economic data like the labor market cooling today. That data is another sign, or the earnings coming out in the next couple of weeks. I think are going to start to show a lot of weakness in the economy. And you take that and it collides with tight Fed policy. I think we're going to look back and say, yep, this was another bear market rally. But I will say one thing, we are getting a lot of progress done on this bear market. I'd say we're in the last phase of it, and but that can sometimes be the ugly part.
So then, James, I mean, what does Fed policy suggest about when this bear market will turn?
Well, when it comes to Fed policy, they usually turn after they've broken more than what's broken already, which would be those banks that were, I would say, somewhat mismanaged. I think in the past, what you've seen historically, that by the time the Fed pivots, they've sort of already pushed the economy, into some level of recession. And this one, we would suggest, is probably going to be a relatively soft recession. But I don't think the Fed is very adamant about looking at backward data. And that backward data says inflation is real sticky around 6%. So the chances of them continuing to raise into economic weakness, sort of puts us in a position where, recession becomes a much higher likelihood. And the problem with equities really here is that they're just not priced for that. You're at 18 times next year's earnings. And that is not really where you would want to find the bottom of the market.
And every once in a while, we get a bit of news we weren't expecting. For example, the output cut that we saw from OPEC Plus that sent oil back above $80 a barrel. And we know that energy has been one of the worst S&P performers of the year. But you're saying that it's been ignored as a sector that you like. What do you think investors are missing here?
Yeah, I think that they're missing a few things. I mean, China coming back online, and basically the valuation of those stocks relative to the rest of the market still says, very reasonably priced relative to forward earnings growth. And that's really what we do at our place is we look at individual stocks and we look for opportunities where there's value and consistency in earnings and a good growth outlook. And in the complex, energy complex is well priced with very good forward-looking earnings in a macro environment that might get weaker sooner than later. But these stocks, like the rest of the market, once this last bear market phase is over with, are going to be a place you want to be going forward.
And you also like consumer staples, healthcare, utilities as well. All have been under pressure so far this year. How are you allocating those in the portfolio?
Yeah, and all these bear market rallies, these defensive positions that we have in healthcare staples have obviously underperformed in each of the bear market rallies. And that's because everyone's sort of going risk on. And then what you find is the market turns over, goes to a new low, and this is where, you're sort of in the island of safety. And that's what's so frustrating about being, a defensive investor during bear markets, which is really what our brand is about, sort of keeping investors' capital safe, being in those sectors that survive the bear market better. And if you look back, the staples, the healthcare and utilities, maybe a bad couple of months, but they've been the stellar performers for the 15 months of the bear market. And we think they will continue to be in this last phase. You'll see a rotation back to those sectors. But at the same time, we're sort of at the end of this last phase of the bear market. I think investors should make a list of great companies that might do real well in the new bull market that we anticipate, which I think, frankly, is probably in the back half of this year.
And what are some of the factors that would go into those picks?
I think some of the factors are really related to when stocks are priced at a point of maximum pain. You've already seen a lot of that in technology, where we're very interested in technology stocks here after many of them have been really hit hard. And we think, if this bear market has that last phase, that would be certainly a place we'd want to go to the highest quality names, where the price earnings ratio relative to earnings growth coming out of recession would look really attractive. So we're making a list, checking it twice, of great tech names. And it's not even a bad idea to tip your toe into buying some shares now and maybe buying more on weakness. The industrial sector, also very attractive, something, again, we've not been investors in, as well as the telecom space, I think, is very attractive. But again, you want to sort of be a little bit more careful that the bear market has kind of cleared all the decks before you could kind of roll into those sectors. So right now, stay defensive, have less stock than normal, but make that wish list, because I think this last phase is going to create some great opportunities.